Hi, today we're going to take a look at the income statement. This video will teach you the core principle of creating an income statement in a new and easier way that you may never have seen before. Specifically, we'll cover what income and expenses are, how to journalize them, and how to reflect them in the income statement. First of all, what is an income statement? It's a statement of a company's operating performance over an accounting period. For example, it shows how much income and expenses a company has earned over the past year, and how much net income it has made. In short, it's the best way to show how much profit a company has made. That's why it's also called a profit and loss statement. It's a financial statement that many people are interested in. But if you take a closer look at the income statement, you'll notice that it doesn't show any signs of double entry accounting. Debits and credits, left and right, and so on. Why is that, even though the income statement is created definitely using the double entry principle? Anyway, how is the income statement even created in the first place? The key to the answer lies in the balance sheet. Why a balance sheet, you ask? It's because the very concept of income and expense comes from the balance sheet. As we saw last time, the following equations always apply on a balance sheet. Here, income and expenses are all related to the change in net assets. In accounting, income and expenses are defined as follows. In short, income is the increase in net assets resulting from business operations, except for capital contributions from shareholders. On the other hand, expenses are net assets that decrease as a result of business operations, except for capital distributions to shareholders. So all changes in net assets, except for capital transactions with shareholders, are called income or expense. I'll illustrate this with a simple example. Let's look at sales revenue as a good example of income. When a restaurant owner serves food and receives money from a customer, he increases an asset called cash. This is an increase in net assets, but it's not a capital transaction with shareholders, so it meets the definition of income. As an example of expenses, we have cost of sales. In order to obtain food resources for the dining service, net assets would have decreased by the amount of the price paid to a vendor. It's obvious that this isn't a return of capital to shareholders, so it fits the definition of an expense. As you can see, the definition of income and expense is quite broad, and most of a company's transactions can fall within the definition. For example, income includes sales of goods, service revenue, interest income, rental income, and so on. For your information, some people use the term revenue instead of income in this context. But strictly speaking, from an accounting point of view, income is the correct term, and revenue is included in the scope of income. Similarly, expenses also include cost of goods sold, operating expenses, interest expense, etc. Now we understand what income and expenses mean in accounting. Then how can we make journal entries for transactions related to income or expenses? Let's start with the most basic concept. Assume that Company A has the following balance sheet at the beginning of 20x1. On July 1st, 20x1, Company A generates $100 in cash revenue by providing consulting services to customers. This transaction is clearly income. Yes, income leads to an increase in net assets, so there should either be an increase in assets or a decrease in liabilities. In this case, we have an increase in cash on the asset side in the journal entry. Balance sheet principles say that if net assets go up, equity should go up by the same amount. So which account in equity should go up? Well, paid-in capital has nothing to do with income because it's related to capital transactions with shareholders. The answer is the retained earnings account. So conceptually, the journal entry for this case should look like this. As a result, the balance sheet will change as follows. Now let's move on to expenses. Let's say that Company A is obligated to pay salaries of $60 to employees who worked in 20x1, and it still has not paid them at the end of 20x1. This transaction fits the definition of an expense because it increases Company A's liabilities and therefore decreases its net assets without a capital transaction with shareholders. So, A journal entry for this expense should reduce the retained earnings in the equity account by the amount of the increase in liabilities of $60. We could consider an entry to debit retained earnings and credit salaries payable like this. As a result, the balance sheet will be updated as follows. Now we can see that Company A's net income for 20X1 is $40, which exactly matches the change in net assets and retained earnings on the balance sheet between the beginning and end of 20X1. This is the basic idea behind journalizing income and expense transactions, changing net assets, and retained earnings on the balance sheet. But there's one big problem with relying on this approach alone. It does not show users of the financial statements the details of the company's activities to earn net income during the accounting period. Let's think about a solution to this problem. What if we added a specific description of the income in the earlier example of journal entries, like this? This new way of journalizing would mean increase the retained earnings account on the balance sheet by $100, and also show on the income statement that service revenue of $100 was generated in 20X1. This journalization would then change the balance sheet, including the retained earnings, and show the service revenue item in the income statement, which explains why the retained earnings changed. Similarly, imagine writing a journal entry for an expense like this. The entry would tell an accounting software program to decrease the retained earnings account on the balance sheet by $60. It would also tell the software to show on the income statement that the $60 salaries expense was incurred in 20X1. Now we're getting close to the meaning of profit and loss accounts that are actually used in real accounting. Let's recall the hypothetical journal entries from earlier. We would simply remove the term retained earnings from the account name, leaving the function of the journal entries unchanged. We'll call them profit and loss accounts, or P&L accounts for short. The profit and loss accounts show specific income and expenses, and they affect both the income statement and the balance sheet. So, when you put a P&L account in a journal entry, it's reflected in the income statement, and at the same time the retained earnings on the balance sheet change by that amount. Therefore, you can easily see that the bottom line net income in the income statement corresponds to the change in the retained earnings over a financial period. So you could say that the retained earnings account is the link between the balance sheet and the income statement. In general, the following equation holds for retained earnings. This shows us that income and expenses are the main cause of change in retained earnings. In summary, income and expense transactions change net assets and retained earnings on the balance sheet, and the income statement indicates the cause of the changes. Now let's practice with a simple example for journalizing income and expenses. Let's assume that Company B's balance sheet at the beginning of 20X2 looks like this. And here are the company's accounting transactions during 20X2. It's pretty clear that the transaction on April 1st is related to income, which means we need to increase net assets. So we debit the accounts receivable on the journal entry. On the credit side, we need to put a profit and loss account. We'll use an account called service revenue, which accurately describe the nature of the income transaction in this case. The entry of the service revenue is then reflected directly in the income statement, and on the other hand, increases the retained earnings on the balance sheet by the same amount. The next transaction on July 6th is about an expense that decreases net assets. In this case, we record the payment of cash on the credit and use salaries expense as a profit and loss account on the debit. As a result, the income statement shows the salaries expense and that the retained earnings go down on the balance sheet. The transaction on September 7th is also related to an expense. In this case, you would make a journal entry like this. This journal entry reduces cash assets and retained earnings on the balance sheet, respectively, and the interest expense is shown on the income statement. The final transaction is to recognize rental income. You do this by entering cash on the debit side and a profit and loss account called rental income on the credit side. This will update the balance sheet and also the income statement respectively. Here is a summary of the previous transactions and the corresponding journal entries. The profit and loss accounts for the transactions are all reflected in the income statement, and the net income for the year 20x2 is calculated to be $1,400. Next, check out the change in the balance sheets between the beginning and the end of 20x2. You'll see that the change in net assets and the corresponding change in retained earnings are exactly the same as the net income of $1,400. This is how the income statement is created and connected to the balance sheet. Let's summarize what we've learned so far. 1. Income and expenses are transactions from operations other than capital transactions with shareholders that result in a change in net assets, and accordingly, retained earnings and equity. 2. The journal entry for income and expenses uses the profit and loss account, which shows the specifics of the transaction. For the income, the increase in net assets is recorded on the debit side, and the P&L account appears on the credit side, and the other way around for the expenses. 3. The P&L accounts in the journal entries will be shown in the income statement and will result in a change in retained earnings on the balance sheet. I'll be back soon with more videos to help you understand accounting better. See you then.